Hello, everybody. Welcome into Commodity Culture, where our goal is to make you a better investor in the commodities sector. My name is Jesse Day, and on this episode, I'm very excited to welcome in Rick Rule to the program. Legendary mining investor, the former CEO of Sprott US Holdings, and the current CEO of Rule Investment Media. Today, we are leaving no stone unturned as we get Rick's latest thoughts on the commodities sector, including gold and silver, both the metal and the miners. Uranium, will it ever get out of its current slump? Energy as well, of course, another sector that is being taken behind the woodshed and slaughtered. Is there any hope there? We're also going to get his thoughts on the current global trade scenario and whether the Trump administration's tariff policies could upend the world order, as well as whether Mark Carney means carnage for the Canadian oil and gas sector. All of this and much more ahead in my conversation with Rick Rule. Rick Rule, it is great to have you back on Commodity Culture. It has been too long since we had a discussion. So I want to start off by just getting a broad overview of where your head's at when it comes to financial markets today. What are you watching right now when it comes to potential opportunities in the markets, commodities or otherwise?
Well, what you're talking about is precisely what I'm doing. I have a lot of liquidity. There is a lot of turmoil in the market. And while there's no guarantee of this, turmoil occasionally breeds real market panics. Turmoil occasionally breeds something like 2008. So mostly what I'm doing is I have a shopping list of opportunities that I'd like to avail myself of, companies in some cases, and I'm maintaining liquidity, looking to take advantage of that. I have a shopping list, frankly, of about 50 or 60 securities, as an example. And I have a nibble price, which is to say a share price that I would begin to establish a position in. And I have a gobble price, which is to say a price where I would really, really, really be an aggressive purchaser. On the other side of my portfolio, I have some speculative positions that I bought a year and a half or 2 years ago because they were really unloved. And I thought, well, I'm going to trade out of these things when they return to favor. So I'm doing that too. There are some companies that I think, in a speculative sense, are approaching their full value at this stage of the market. And I'm cycling out of those, looking for opportunities. So my portfolio is in flux. I would say that the dominant characteristic of my portfolio relative to many other portfolios is liquidity. I own, relative to the size of my portfolio, a lot of gold, and I have, relative to other portions of my portfolio, a lot of short-term cash, a lot of liquidity.
And how much of that portfolio, whether we're talking about your watch list at present or the speculations you've made that you're potentially be rotating out of, how much of that is in the gold mining sector at present? And what are your thoughts just in general when it comes to the value proposition of the gold miners? Because I talk to a lot of people who believe that there still persists a large valuation gap between the metal and the miners. What are you seeing there?
I'm overweight the gold miners for two reasons. I became an aggressive buyer of the large gold miners 3, 4 years ago, and those positions have done extremely well. So the gold miners have become a bigger portion of my portfolio, partially organically, which is to say positions like Wheaton Precious, Agnico Eagle, Lundin Gold, G Mining, Franco-Nevada. They've gone up so much in price that the aggregate value of my gold portfolio is up over 150% before portfolio additions. But in addition to that, I believe that we're fairly early on in a gold bull market. I've lived through, this will be my fourth gold bull market, and they follow predictable patterns, Jesse. The metal moves first. When the metal has moved far enough, fast enough that uh, the gold price has outpaced the inflation in the inputs to produce gold, the margins in the biggest and the best gold companies move. You'll remember, Jesse, some frustration on the point of your listeners in 2003 when the gold price moved, but the gold miners didn't move. There were two explanations for that. One, the gold price moved because central banks were buying it. They don't buy gold stocks. The other was that the cost of producing gold was increasing as fast as the gold price. Beginning in 2024, the gold price accelerated faster than the inputs, and you started to see rapid margin expansions in some of the better gold producers. Two things happened there. They became worth more, but they got assigned a higher multiple too, as the narrative of the gold price extended to the gold miners. This occurs when you're usually about a quarter of the way through a gold bull market. So I suspect, if past is prologue, that we're a quarter of the way through this gold bull market. I believe, Jesse, that the cause of this gold bull market is primarily the deterioration in the purchasing power of the US dollar, particularly relative to the interest being paid on US dollar denominated savings, which is to say negative real interest rates. And I believe that phenomenon will be with us for a fairly long time. Specifically, I believe in the next 10 years that the US dollar will lose about 75% of its purchasing power. It will do relative to other currencies, but it won't do well in the absolute sense. I saw this happen myself in the decade of the 1970s. In the decade of the 1970s, the US dollar lost 75% of its purchasing power. I mentioned this in this discussion because in the 1970s, the price of gold went up 30-fold. I'm not suggesting that the price of gold is going up 30-fold from here, and we could discuss why on another interview. But I do believe that the gold price will keep pace with the deterioration of the US dollar, which is to say, I don't think that gold goes higher. I think it goes much higher. And I think that that will expand the earnings of high quality gold companies, and I think it will expand the multiples that they're accorded too. That's a very long way of saying I am long the gold stocks and looking for opportunities to increase my exposure to high quality seniors and high quality juniors.
And now a quick break to hear from our sponsor, ARC Silver Gold. Osmium owner Ian Everard is considered one of the most honest and level-headed gold and silver dealers in the United States, praised even by his competitors. So give him a call today to take advantage of the specials right now. Silver Kangaroos 2023 1-ounce coins, mint fresh, only $2.47 over spot. Mint fresh silver maple leafs 2025 coins, 1 ounce, $2.87 over spot. While supplies last. Reach out today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you. And now, back to the interview. And what about silver, both the metal and the mining equities? And one thing I wanted to pick your brain on was the gold to silver ratio, because I talked to a lot of people on this show who say the gold silver ratio is historically stretched. And so that means silver must rise eventually to revert to the mean. Are you a proponent of that sort of thinking, or is it more complicated than that?
I'm not. I think the gold silver ratio is a factoid. I think it's a useful factoid for traders because so many people believe it. Something doesn't have to be true to be important. The gold silver ratio refers to the difference between the relative price of gold and silver and their relative abundance in the Earth's crust. People like it because it's an easy to grasp statistic, but I think it's pointless. It doesn't take into account, as an example, the cost to produce gold or silver. Most silver is produced as a byproduct of other metals, which means the production costs for 78% of primary silver production is kind of irrelevant. It's low, unlike gold. It doesn't go to utility either. My experience has been that precious metals bull markets follow predictable patterns. The momentum is established by gold because the first buyer is a fear buyer. When the momentum in gold has attracted enough generalist investors that they come into the narrative, leadership changes from gold to silver. Perhaps because of silver's relatively lower unit cost, perhaps because of its reputation, historical reputation for volatility. I don't know why, perhaps both. I just know that. When that happens, Jesse, you won't need Rick Rule to tell you it's changed. Those moves are generally very dramatic moves. So in answer to the first part of the question, I'm overweight gold. I have a weighting in silver, but my suspicion is that we don't see a real rip-roaring silver bull market for as much as a year or a year and a half. and it's a higher risk circumstance. I have about 2.5% of my portfolio in silver stocks. It wouldn't surprise me to see that become 20% of my portfolio organically with no with no additions. But it wouldn't surprise me either to see that move take place 2 years from now, 3 years from now, 4 years from now. I have the financial and psychological wherewithal to wait 2, 3, 4, 5 years. Many speculators don't. I also have the psychological makeup that I can stomach a lot of volatility. Small silver stocks can increase or decrease 10% in price as a consequence of the disposition of one institutional investor. They can go up or down 10 or 12% for no reason whatsoever. It takes a fairly large degree of psychological maturity as a speculator to stomach that volatility. I've had 60 years to learn that kind of patience. So I can do it, but many can't.
Could you give us any insights into your own silver portfolio, maybe a few names that you're the most bullish on and the reasons why?
I start with the best of the best. I have Wheaton Precious, which admittedly is primarily a gold stock. I have Pan American, which is primarily a gold stock, but is also silver centric. I also take some political risk. I have Peñoles, I have Fresnillo. I'm willing to take the Mexican and the Peruvian political risk in order to lower my median production cost profile. I also have a relatively large holdings in the high quality silver juniors. So Vizsla Silver, Dolly Varden, although that stock has done so well that I reduced my position a little bit, I have the rest for free. Aya Silver, because I'm a long-term fan of that management team. Abra Silver. I have a portfolio of silver juniors, not the cheapest, but rather the best. When I do a net present value calculation, a present net worth calculation on one of those juniors using a $30 silver price, I come up with a fairly nice net present value number. Even if I discount it back to a production start 5 years from now or 6 years ago, 6 years from now. If I add a contingency price, say a $50 silver price, or if I run a $75 silver price, not that I believe that we're necessarily going to see $75 silver, but it's certainly not out of question. The numbers I get on these high quality juniors, penalizing them any way I want to for start date, is silly, truly silly. I don't own the rinky dink, low quality, high leverage silver juniors. I don't like small deposits. I don't like high cost deposits. There is enough leverage in the high quality silvers that I don't need to expose myself to the leveraged companies. I don't need, putting it in stark arithmetic sense, I don't need a 5% probability of a 30 bagger when I can engineer a 70% probability of a 4 bagger. That arithmetic just makes much more sense to an old pawnbroker like me.
Yeah, I think that should be a pretty acceptable return for anybody. Forex is a phenomenal return on investment. I think we live in an era of meme coins going up thousands of percent and the whole GameStop mentality. And so people are chasing 10 baggers, 100 baggers without any real knowledge of how to identify such companies. One other thing I actually want to pick your brain on when it comes to silver is another thing people talk about is that silver is so far off from its previous all-time highs, and therefore it's an absolute bargain today. And even if we're discounting the Hunt Brothers episode, The Silver Squeeze, which I believe was in 1980, and we can go back to 2011 where silver almost got to $50 an ounce once again. Adjusted for inflation, that means triple digit silver. Is this something that you watch at all? Do you compare current silver prices to previous all-time highs, or is that all just noise?
I don't. I think that's a factoid too. I do understand that $50 in 2011 dollars is more like $125 today. And $125 obviously wouldn't surprise me, given that I think that the gold price is going much, much higher. I don't have a way to assign any certainty to it, which means I think it's a contingency worth speculating on, as opposed to a certainty worth investing on. I like to say that I have 2.5% of my portfolio in the silver stocks. If I'm wrong, if my silver stock portfolio fell by 50%, it wouldn't change my decision as to what to have for breakfast. It wouldn't change anything. If, however, my silver stock portfolio ran tenfold and 2.5% of my portfolio became 20 or 25% of my portfolio, that would be a lot of fun. The juxtaposition of risk to reward in a speculative asset class when I can afford to speculate is very, very high. People need to ask themselves that range of question. What return do you need? Are you willing to do the work to justify the return that you would like to see? How financially and psychologically capable are you to wait for 2 or 3 or 4 or 5 years? And how much volatility can you stomach in the interim? And what happens to your lifestyle if you are wrong? Flat wrong. The answer, Jesse, is less about the silver market and more about the person asking themselves the question.
Let's talk about uranium, because at present, the uranium equities have been taken behind the woodshed and slaughtered. We spoke about this very fact, the low sentiment, the low prices in the uranium stocks back in January at the VRIC. Since then, URNM has fallen an additional 12%. For those who don't know, that's a uranium ETF from Sprott that holds a basket of the miners. But if we zoom out a little bit, 5-year time frame, URNM is actually up around 160%. So is this a question of just getting in at the right time for those people who've entered the uranium trade? Let's say when the Sprott Physical Uranium Trust first came onto the scene, we've never retraced those highs in many of the equities. Is it just a matter of timing? Are people who got in at the highs too late to the trade, or do you think there's more upside up ahead?
Well, there's a lot to unpack there. First of all, the fundamentals around the uranium business are superb. They are truly superb. They were good in January. They're better now. And the price is down by 12%. If there's an asset class that you'd like to buy that got better and it became cheaper too, the idea that somebody complains about that is really, truly strange. The person who would complain about that is a person who would go out to buy a winter coat, find it marked down from $500 to $400, and accuse the merchant of gouging. This is truly insane. Truly insane. If you believe in the asset class and you believe that performance of the asset class is a when question, not an if question, the fact that 6 months has gone by means that the when question will answer itself sooner than it would have 6 months ago. I'm delighted, too, by the hate that silver experiences. You have a whole bunch of social media commentators that used to have uranium as part of their handle who have capitulated. There is nothing I love more than hate. And I monitor the social media partly because I do think sentiment is an investment fundamental, and partly because it amuses me. And I see a total lack of interest in anything relevant about uranium, and a lurid fascination of the aspects of the market that are really truly a sideshow. People, as an example, pay slavish attention to the spot price. In an economic sense, more dollar volume takes place in the Sprott product than in the spot product. One could say that the spot market has become the Sprott market. At the same time, not one speculator in 1,000 looks at the structure of the term market. The term market is a structural advantage that uranium has that no other commodity has. A buyer and a seller can negotiate price and terms that last 5 years, 10 years, 20 years, 30 years. Try to do that in cobalt. Try and do it in oil and gas. Try and do it in gold. Try and do it in copper. You can't. The import of that is that a junior that would otherwise be unable to finance a mine into production on their own balance sheet can pre-sell some of the product to investment-grade counterparty, Ontario Power, Duke Power, Southern Company, China General Nuclear, and literally take that contract to the bank. This is a hugely important development. And when you look at the discussion groups around uranium, the fact that the single most important structural element in the uranium market generates no attention whatsoever tells me the value of the rest of the chatter on those websites. I'm delighted that that chatter exists. There are 10 or 12, I think, high quality uranium juniors. I'm not sure whether if somebody built a portfolio of those, they'd be happy in December. I can tell you that they'll be ecstatic in 2030.
Now, do you think part of the misconception of many investors in the uranium sector is because they're following the spot price more closely than anything? Because, the spot price accounts for 10, maybe on a good year, 20% of all transacted uranium volume in a given year. And yet everybody's fixated on it. Sometimes I interview CEOs of uranium companies, and they will even fixate on it as a point of bullishness to say, oh, the spot price looks like it's going up now, or if it's coming off its bottom, this is a really bullish sign for uranium stocks. Is that the issue, you think, when it comes to most investors looking at the uranium space? And as a bit of a sidebar, does that kind of by proxy make the spot price more important than it should be because it drives investor sentiment so much?
In answer to the last question, the answer is clearly yes. It's a factoid, and people are attracted to it because they don't want to do any work. It's an easy to grasp statistic. It's meaningless, but it's an easy to grasp statistic. I think the fault in a psychological sense in the United States goes back to the way we were brought up, believing in the tooth fairy. People remember the money made by speculators like me in prior uranium bull markets, and they want some, and they want it now. I've graded tens of thousands of portfolios, Jesse, as you know, over the last 25 years. And I would say that one of the most common mistakes that people make is that they have a very, very, very good strategic sense, but then they employ the wrong tactic. If you believe that the uranium market and the uranium equities markets will materially change for the better over 5 years, but you have trauma holding stock over a long weekend, you naturally are going to subsidize me. I thank you for it. When your emotions are running high, you're going to pay too much for my inventory. When your emotions are running low, you're going to sell high quality paper to me on the cheap. Thank you. Thank you. That's all I can say. People need to do two things. They need to do the work. They need not to buy something just because uranium is part of the title of the company. They need to develop the tools to separate the good from the bad from the ugly. And they need to coordinate the duration of their strategies and their tactics. Jesse, I've said on your show before, I love questions where the answer to the unanswered question begins with when, not if. And I believe that uranium as a topic is a question where the answer begins with when. Not every uranium junior, assuming there's 100 of them, probably only 10 or 12 of them, have an outcome where the answer begins with when, not if. So the first thing that speculators must do is look at that 100 company universe and learn how to segregate out the 10 or 12 companies where the question begins with when, not if. After that, the speculators need in their own mind to synchronize their tactics with their strategies.
Well, another area I want to discuss is the energy sector, oil and gas equities, as they have also been slaughtered recently. I spoke to Louis Vincent Gauve the other day. He's been bullish on the energy sector for a few years now, perhaps longer, and he said it's been his cross to bear. Sometimes he looks at his portfolio and he questions himself a little bit. The fundamentals all seem to be there, much like with the uranium space. Nonetheless, we did see recently the WTI crude price drop below $60 for some time. It's recovered somewhat since then, over 60 as we're speaking. But how much lower can the oil prices go at this point? Because many of these producers are not profitable at a $50, let's say, WTI price. So is this a situation, as you like to say, where the cure for low prices is low prices? What are your thoughts?
It took us 2 years to work through the inventories from COVID. The oil price right now is telling you that we are slipping into recession. This has nothing to do with U.S. overproduction. U.S. rig counts are down. This has everything to do with the fact that, irrespective of the pronouncements of the big thinkers, we have an economic slowdown. It's happening right now in real time. For people who believe that the economic slowdown will continue and deepen, the oil quote goes lower. Make no mistake, in this circumstance, the cure for low prices is low prices. When the prices were higher, the International Energy Agency suggested that the oil industry as a whole, including parastatal oil companies, was underinvesting in sustaining capital to the tune of about $1 billion a day. You don't maintain production skimping on sustaining capital investments. The exception to that was the United States and Canada. And sustaining capital investments in the United States and Canada are falling too at $60 oil. The combination of lower oil prices and higher interest costs, higher costs of capital, is very ugly for near-term production. This is a self-correcting phenomenon, but it isn't a self-correcting phenomenon in a time frame that appeals to many investors who were taught in the period 1982 to 2022 that markets only go up, and they only go up in the near term. I love this circumstance. I This sounds unhumble, but I don't need to get richer, but I want to get richer. The idea that there's an asset class that I'm certain that's going to perform, certainly, particularly when I can buy the best of the best, which is called Exxon. Uh, Exxon, again, you may or may not be happy owning it at Christmas this year. You will be ecstatic 5 years from now. And by the way, you'll pocket a generous dividend between now and then to make owning it easier. The Canadians are more challenging. I own a package of high quality Canadian oil stocks because I think they're selling at half the relative valuations of their U.S. cousins. They're doing that because the new Prime Minister of Canada, like the old Prime Minister of Canada, is hostile to the industry. You don't need to go to Iraq to find political risk. You can find it in Ottawa. Despite that, I own the stocks because they're felony cheap. And I believe that even in Canada, the federal government's need for revenue is going to outpace their anti-carbon leanings. If I'm wrong, I'll take a bit of a whack.
Let's hone in on Canadian oil and gas equities because I have not spoken to you since Mark Carney was elected Prime Minister of Canada. Obviously, he comes from an economic background, but he's very into net zero, eliminating carbon. Hydrocarbons are evil, that type of thinking. And then he's also now appointed a Minister of the Environment and Climate Change. Now it's right in the title, Minister of Environment and Climate Change. So there you go. It's front and center. And this minister shares Carney's zealous views. Do you think Mark is smart enough to know that he has to build pipelines, he has to support the oil and gas business to unlock the economic value? Or does he have different incentives? Perhaps his incentive is not for Canadian economic growth. What do you think?
He will ultimately do what the voters tell him to do. You notice, as an example, that he suspended the carbon tax. He was the author of the carbon tax. Had he not suspended the carbon tax, he wouldn't have become elected. Ultimately, Canadian voters, including Liberal voters in Ontario and Quebec, perhaps mostly Liberal voters in Ontario and Quebec, will tell him what he has to do. You will notice, I mean, I've met him a couple times. He wouldn't remember. I do. He's an enormously bright guy. He's an enormously capable guy. In some senses, he's the worst of all worlds. You have a guy that has Trudeau's sensibilities, but much more competence. I would prefer my enemy to be incompetent as opposed to competent. And Carney is no part of that. If you'll notice that he ran on a campaign for change, despite the fact that he was behind the throne, shaping the policy of the last 10 years, he somehow convinced Canadians that he was the voice of change. He did something else really smart. He ran against Trump. I didn't see Trump's name on the Canadian ballot anywhere. And Canadians fell for that because he was comforting. If the economic performance in Canada continues as poorly as it has under the Trudeau administration, if they lose competitive advantage to the United States as rapidly as they have over the last 10 years, patience with the patience of the Canadian voter with regards to Mr. Carney's policies may force him to change those policies.
I want to shift to discussing more of the broad economy at the moment, and specifically the effects of the Trump administration's tariff policies. I want to read a quote here that Trump posted on Truth Social in response to Walmart stating they're going to have to raise prices in response to these tariffs. Trump says, between Walmart and China, they should eat the tariffs and not charge valued customers anything. I'll be watching, and so will the consumers, so will the customers. This literally sounds like the words of a raving madman. Is he just trying to shift the blame here so that ultimately, if we see these tariff policies raise prices, leave empty shelves, all of these sorts of things that people are fearing, that he can then point to somebody and say, look, it's their fault. These greedy corporations are gouging you. How is this all going to play out?
To put this in context, I think you need to read Mr. Trump's own book, The Art of the Deal. Mr. Trump is a transactional human being. He's the consummate politician. Having established that, let's establish that he is non-ideological and he's transactional. He's about policy. For Trump, tariffs are great policies. They are tools that appeal to his base, a nationalist base that is afraid of foreign competition, not the traditional American base that says, bring it on. We're going to win by being the best. At the same time as it's a tool that allows him to punish his enemies and reward his friends. What better tool for a politician? Let's look at tariffs themselves. Tariffs are taxes. That's what they are. Taxes are, first of all, a burden on a consumer. They're also an input cost. Just for fun, I looked at a couple years of income statements for Walmart. They generate about a 2.5% return on sales. They have a 2.5% margin. Now, if you enjoy a 2.5% margin on sales and somebody increases your input cost by 30%, you're going to eat it? I mean, it is amazing how gullible voters on both sides of the 49th parallel are. It is amazing how much voters are geared to rhetoric and emotion, and how little patience they have for arithmetic and economics. Assuming that you thought for a second that tariffs might be good policy, I don't. But assuming that you did, or assuming that you were an economic nationalist, the idea that Mr. Trump has decided to pick 100 fights simultaneously, turn 100 friends into 100 enemies, is also bad arithmetic. If you're going to pick a fight with a high probability of a successful outcome against an enemy, one enemy at a time. Probably my favorite, if I have a favorite, global politician in the last 150 years was the guy who led Turkey out of religious politics into secular politics, Kemal Ataturk. The country has deteriorated back into religious politics, but at the time, Ataturk described his foreign policy as many friends, no enemies. You know, he had Russia above it, he had Iran on one side, he had Iraq and Syria on the other side. You know, he he existed in a hard place. He said many friends, no enemies. The foreign policy that I would prefer is many friends, no enemies, but enough pontificating. Suffice it to say, tariffs are taxes, and taxes are bad. We have in North America, despite the best attempts of the politicians to screw it up, a fairly integrated economy, and it's served us fairly well. It's worthy to note that our fair trade agreement, NAFTA, had 3,600 pages. There's nothing fair about 3,600 pages. Jesse, if you and I decided to have a fair trade agreement between you and I, it would have a paragraph. There shall be no financial or non financial legal impediments to the free exchange of goods and services between willing buyers and willing sellers. Stop. That's what a fair trade agreement looks like. NAFTA was a managed trade agreement, and Trump didn't like the terms. He's not trying to make the agreement fairer, he's trying to make it more transactional, which is evil.
Yes, as most politicians are. It's funny though, you will see in the comment section below somebody getting really angry because you're talking negative about Trump. They'll literally say, I stopped listening to him the moment he said he doesn't agree with Trump, which is a completely insane point of view in my mind. But the same thing happens on both sides of the political aisle. If you say something positive about Trump, people say you watch too much CNN or something. I mean, it's completely insane. But one thing that I do wonder is, do you think this tariff policy and how it's kind of moving so quickly has something to do with the fact that President Trump is on his final term? He wants to leave a legacy. He wants to make an impact. And he also has a limited amount of time to do this before the midterm elections, when the House could get packed with Democrats and they could reverse everything he's done and, try to impeach him and all that sort of stuff. Do you think that's kind of guiding his decisions here?
No, I think he's transactional. I think it gives him the best possible tool to reward his friends and punish his enemies. I think if Canada's economy was 12 times as larger as the United States' economy, that Carney would do the same thing. I think that those people who aspire to great political power want to dictate how other people live their lives. And I think that the way that they aggregate power and the ability to do that is transactional. This is a wonderful tool for Trump at the expense of everybody who isn't viewed by him as a friend.
Yeah, very well put. I actually have a theory, and I think it's at least partially true, that most high ranking politicians are narcissists, sociopaths, and of course, at worst, psychopaths. They're devoid of empathy for other humans, and most of the decisions they make are to consolidate their own power, enrich their inner circle, etc. But that's going out on left field a bit. I want to read a tweet recently posted by Porter Stansberry. Get your thoughts here. He said, Bank of America is sitting on $700 billion in bonds bought at 1% yields in 2020. Those bonds are down around 40%, hiding $100 billion in losses. Meanwhile, the Treasury needs to refinance $9 trillion and issue $2.5 trillion in new debt this year. Foreign buyers like China are dumping treasuries for gold. Are things as dire as Porter is proclaiming here? Because we keep hearing that the U.S. debt is untenable, everything's going to blow up every day now, and yet the can keeps getting kicked down the road. How close could we be to a real debt crisis in America?
That's an interesting question. First of all of the arithmetic that Porter gave you is true. I've learned now at age 72 that in the short term, neither voters nor investors paid attention to arithmetic. They pay attention to emotion, training, feelings. We've gone through a period, 1982 to 2022, that were the most benign economic climate in human history, particularly for Americans. Real and nominal interest rates were falling. The U.S. dollar was strong, so we could export inflation. The benefit of demographics, which is to say the baby boomers, the benefit of global trade liberalization, a wonderful time. All that's changed. But I don't think that investor perception has changed. I think that we've been schooled through 40 years of benign times to be probably more aggressive, more positive than we ought to be. In the near term, with regards to Bank of America, as an example, uh, the regulators, in their wisdom, have allowed Bank of America to say that those obligations aren't being held for trading, they're being held to maturity. And if they will pay off, that they can value them on their balance sheet, uh, not at market, but rather at par. Um, and I believe that not one investor in 20 knows the difference between mark to market. You know, it's a legislative sleight of hand that people don't care about. The last time I saw people care personally was 1973. And that was an interesting change of circumstance. I don't know if the change of circumstance will occur. I happen to believe that the US government will be able in the near term to roll over its debt because I believe that the American people have looked at quantitative easing, that's Fed speak for counterfeiting, is a good thing. That's how you manage an economy without any pain to individual voters. It reminds me of the Hemingway quote. I'll only paraphrase it because I don't remember it. How do you go broke? Gradually at first, then all of a sudden. It becomes a problem when it's perceived to be a problem. I can tell you this. I'm delighted to be starting up a new bank that has no long bond portfolio when so many of our competitors that might otherwise have competitive advantages over us with established banking relationships have real, true balance sheet constraints. Um, the problems that I discuss in my work, $141 trillion in private net worth in the United States against $130 trillion in net government debt, is a problem over a decade. What Porter describes probably is a problem over a decade. I think what investors need to focus on, and speculators too, is the fact that the way out of the dilemma described by Porter and the way out of the dilemma described by Rule is to reduce the purchasing power of the US dollar. You reduce the aggregate net present value of the debt while honoring the nominal value of the debt. In the decade of the 1970s, according to the Office of Management and Budget, the US dollar lost 75% of its purchasing power. This isn't a number put up by some cranky old libertarian named Rick Rule or a young copywriter, great thinker named Porter Stansbury. This is the Congressional Budget Office. By doing that, we devalued the net present value of the obligations run up by the war in Vietnam and the war on poverty. We got through it. It was ugly. There was a reckoning to get through it. Interest rates quadrupled. It was not a pretty time, but we got through it. And we're going to get through this too. Investors need to be concerned because we're heading into this period of turbulence with on-balance sheet and off-balance sheet liabilities in a real, not a nominal sense, that were 4 times as high as they were, which is to say there's less string to push. But we're also heading into it with a society that's enormously richer and more competent. If you look at the gains in technology and efficiency that we've enjoyed since the period of the 1970s, this is still a time where a bunch of young kids can commandeer a garage in Sunnyvale, and out pops Google or out pops Apple. That does 2 things. It makes a bunch of folks rich, but it also lowers the cost of doing business. It makes the solution to global problems less capital intensive. So we'll get through this, but it ain't going to be as easy as getting through the last 4 decades was. I think it's important to know that. I think it's important too that people understand one solution to this problem, 2 solutions perhaps. Despite the fact that your savings reduce your wealth, despite the fact that you're being paid 4.2% in a currency that's depreciating by 7.5 or 8, you have to keep liquidity anyway. Because in a circumstance like 2008, If you have liquidity, you take advantage of the situation rather than being taken advantage of, by it. The other thing that you need to do is, if history is a guide, you need to have part of your wealth stored in gold. In the decade of the 1970s, when the purchasing power of the US dollar fell by 75%, the gold price increased 30-fold. I'm not suggesting that the gold price increases 30-fold from here. It's already up 12-fold from the year 2000. What I'm suggesting to you is that the gold price likely increases in proportion to the deterioration of the purchasing power of the US dollar over 10 years. And a little bit of gold gives you a lot of insurance. If I'm right, having 10% of your net worth in gold salvages a lot of the purchasing power that you lose elsewhere in your portfolio. If I'm wrong, maybe 10% of your portfolio becomes 7% of your portfolio, as opposed to 10% of your portfolio becoming 50% of your portfolio or 40% in the scenario that I envision. It's good arithmetic.
The Rule Symposium is coming up. It's going to be July 7th to 11th in Boca Raton, Florida. Rick, give us an overview of the conference. What can we expect this year?
A lot. I'm delighted to say I think that this is the 30th year that we've done the symposium. So first of all, it stood the test of time. If you make something a little bit better every year for 30 years, after 30 years, it's pretty good. And I would suggest that it's better than pretty good. Here's why. First of all, we give you the kind of macro that you and I have been discussing today, not the kind of macro that you would see on CBC or CNBC. All of our macro commentators are people with real experience in the sector, not journalists or influencers. We start off with David Stockman, who literally presided over the Office of Management and Budget, the predecessor to the Department of Government Efficiency in the Reagan years. He wrote a book describing the political derailment of the Reagan Revolution within 6 months of Reagan's inauguration. That was called The Triumph of Politics. Much more recently, he's written a book called How to Actually Cut $2 trillion from the U.S. budget. I say this because he's not a failed journalist, but rather he's from the belly of the beast. He talks about the circumstance that he himself lived through and experienced. We move on to Nomi Prinz. She talks about the nature of Wall Street, the corrupt nature of Wall Street, not as somebody who graduated from some pinko journalist school, but rather as a partner at Goldman Sachs. Again, from the belly of the beast. That's my theme in macro, the belly of the beast. Daniela DiMartino Booth talks about the Fed because she was a Fed researcher. Jim Rickards talks about the intersection of Wall Street and Washington because he presided over some of it as general counsel at Long-Term Capital Management, whose failure almost brought down Wall Street. It's important that our macro thinkers were players, not observers. We move on from there to analysts and portfolio managers, not Johnny-come-lately in resources, not people who 3 years ago couldn't spell uranium, but rather people who've lived on the front lines allocating capital and natural resource markets through good markets and bad for 4 decades. That's important. The John Hathaways of the world, the Adrian Days of the world, people who are present and have been present for 4 decades where the rubber meets the road, telling you how to employ the strategies suggested by the macro thinkers to your own benefit. We go from there to the living legends, people who have built multi-billion-dollar mining and oil and gas companies from scratch, telling you how they did it, telling you how it made them better investors, and telling you how to identify a $20 million market cap company that's going to become a $5 billion market cap company. Jesse, understand at my conference, every single public company has been vetted. If the conference sponsors don't own those stocks in their own portfolio, we don't let them exhibit on our floor. We turn down more exhibitors than we accept because our attendees have told us that our exhibitors are content too, not mere advertisers. Another thing about putting on a conference for 30 years is that you develop a core of attendees who have an awful lot of knowledge. The idea that all the knowledge at my conference emanates from the dais to the assembled is ridiculous. There are very high quality people in the audience. You meet them in the breakout sessions. You meet them at the bar. You meet them at coffee. There's a lot of value there. Unlike other conferences, our conference, although it extends for 4 days, really extends for 300 days. Before the conference, I interview every single exhibitor, and those interviews are published at the Rule Classroom and at YouTube. So by watching those interviews, you can allocate your time at the conference more efficiently. We tape the entire proceedings, and whether you attend live or via live stream, those tapes are available to you for a year after the conference, and you're going to need it because we give you more information in 4 days than you could absorb in 4 days. And then after the conference, we maintain discussion groups in the Rule Classroom around the topics of the conference, including the affairs of the exhibitors, for a year. The upshot of all this, which is to say great macro, great implementation, a vetted list of exhibitors, means that I can say to anybody who attends my conference, either live or last year in 33 countries via live stream, you have an ironclad money back guarantee. If for any reason you don't believe that I haven't earned the tuition I charged you, email me. I'll give you your money back. That guarantee has been in place for 30 years. I've had to refund less than 0.1% of the tuitions I've charged. But it's your guarantee that you're going to get your money's worth. The financial risk of attending my conference, live or live stream, is all mine.
Great. Well, once again, the Rule Symposium will be July 7th to 11th in Boca Raton, Florida. Get your tickets today. There is a link in the description below where you can grab your tickets. Rick, it's always an absolute honor having you on the show. Thank you so much, and I'm looking forward to our next conversation.
Pleasure, Jesse. Thank you. I look forward to seeing you somewhere, somehow, in the immediate future. Thank you.
And thank you for joining us today. This episode is brought to you by ARC, Silver, Gold, Osmium. Take advantage of their specials right now. 2023 Silver Kangaroos, 1 ounce coins, $2.47 over spot. Silver Maple Leafs, 2025 1 ounce coins, $2.87 over spot while supplies last. Reach out to owner Ian Everard today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you, and I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.